Hi, this is Mark Teran, your mortgage man, and today I'm here with my partner,
Melissa Carson, and we're here from American Pacific Mortgage in Fair Oaks, California. Today we're on location at Lake Natoma on a beautiful sunny afternoon, and we're here to present to you a strategy that is a win-win for both buyers and sellers in our current real estate market.
Yeah, so the market's changed over the last year. With the interest rates starting to rise last February, we saw a little softening in the market.
Sure did. Buyers want a lower interest rate and lower payments.
And the sellers, they want to maintain a higher price and put more money in their pocket.
So here's a strategy to bridge the gap that lowers the buyer's monthly payments and nets the seller more money at closing.
It's called a buy-down strategy, so let's dive in. So there are two types of buy-downs. There's a permanent buy-down that lowers the interest rate for the life of the loan. And then there's a temporary buy-down. Typically, most often, we see it lowered for the first 2 years of the loan, but we also have available the first 3 years. So it's a 2-1 or a 3-2-1.
And what are the benefits of a buy-down? Well, there are two types, as Mark mentioned. You have the permanent, which the benefits of that are lowering the monthly payment. It's less expensive than a price reduction and can be paid for by the seller or the buyer. And then you have a temporary buy-down, which keeps your payment lower in the early years of the loan, and it's less expensive than a price reduction, and it must be paid for by the seller.
So a permanent buy-down is simple and easy. You're going to pay points up front to get a lower interest rate, and that lowers the rate for the life of the loan. That's what we mean by permanent buy-down. That fee can be paid for by either the buyer or the seller. They can even split it. The benefits of it is the lower rate means lower monthly payments, means it's easier to qualify. And in today's market, which because it's softened a little bit, I often see roughly at 2 points, and 2 points most often is equating to about 7/8% reduction in the interest rate. So if you look at our chart here, the first column, we've based it on a 600,000 sales price. The first column is based on market interest rate at 0 points. The second column is based on a 5% seller reduction, which is $30,000 at this price point. And then the third column, we're showing you the buy down strategy. And buying it down 2 points costs that seller around $9,600, and it lowers the buyer's monthly payment by about $272 per month. So at the end of the equation, the seller's netting $20,400 more than if they had done a price reduction. The buyer's lowering his payments by $272, and it helps him qualify more for more. It's a win-win.
Now let's talk about the 2-1 temporary buy-down. The 2-1 buy-down strategy is that for the first 2 years of your loan, you save money each month. First year, you're saving 2% on your interest rate. The second year, you're saving 1% on your interest rate. And years 3 through 30, you're back at market rate. So if you look at this chart, it'll show you the first year, which is the 2% lower on the interest rate, and it saves you about $600 a month. Then if you look at the second column, it's second year, and you're saving 1% on your interest rate and about $300 a month. And the third column shows you years 3 through 30 at market rate. The fee for this is paid for by the seller, must be paid for by the seller. The money is put into an escrow account. And should interest rates drop within the first 2 years of having this temporary buy down, and you decide that you'd like to refinance, that money is not wasted. That money that's left in that account will go towards your principal balance. So it's a great option for both buyers and sellers. In this scenario, the seller still saves about $19,000 versus lowering their purchase price.
So here we have a comparison of the temporary buy down versus the permanent buy down. And either one of them is a great strategy. The permanent buy down, the seller's going to need to contribute about $9,600, or the buyer if they so chose. But in this market, often we're able to get the seller to assist. If you do the temporary buy down, it's going to cost the seller about $10,900. In the grand scheme of things, at this price point of, let's say, $600,000 as our example, they're roughly about the same. The whole point of this, it's a win-win for both buyer and seller, and the buyer can decide what's best for them. Some folks are looking at, hey, I'm going to get a promotion, or I'm going to be paying off this car in the next 1 to 2 years. So it might be more important for them to be in a temporary buy down and get that payment down much more in the beginning years. Other buyers are like, I want it all now and I want it done for the rest 30 years. We don't know what rates are going to do, so we're happy with that. Either way, both parties win.
If you're a realtor with buyers looking for a way to get their offer accepted, please send them our way and we'll get them pre-approved for you quickly. If you're a realtor with listings, please share this strategy with your sellers as a way to motivate them to work with potential buyers and net more in their pockets. They may not be aware of this strategy. And if you're a buyer, please give us a call and we'll go over any questions you might have and we'll guide you through the pre-approval process. Thanks so much.
How do you feel?
I'm good. I'm refreshed.
All right.